Welcome back to The Explainer. Today we're doing something a little different. We're setting aside the usual highlight reels for a raw, documentary-style analysis of the GoldMining Ninja's Cent Account challenge. This is episode 7, The Autopsy. And I want to set a really calm, deliberate tone right out of the gate here because, well, we aren't here to celebrate a massive win today. We're here to conduct a clinical, objective review of an account-ending event. You know, when we talk about automated trading, the massive successes are always front and center, but honestly, the failures are where the real educational value hides. So let's just get right into it.
8.66 cents. Just take a second to let that number sink in. That is the cold, undeniable reality of the final remaining balance of what was until very recently a thriving, highly active account. It's a pretty striking reality check, isn't it? When a trading system finally meets its breaking point, it doesn't really give you a polite warning. It just leaves you with pocket lint.
So, looking at the Week 25 summary, this is really it. The end. This explainer is documenting the brutal, rapid destruction of the account during this specific week. We're choosing absolute transparency over the standard trading hype you usually see online. There is zero sugarcoating what happened here. The massive red arrows and that brutal downward spiral tell you exactly how catastrophic this final week was for the strategy.
Let's lay out the stark numbers of this final week. The weekly result was a staggering negative $7,101.52. That translates to a weekly gain of negative 99.88%. I mean, we are talking about a nearly 100% loss of capital in a devastatingly short window of time. The final balance, like we just mentioned, sat at a mere 8.66 cents. And that maximum drawdown for the week, it peaked at almost 25% right before the final sequence of trades locked in those catastrophic losses.
Just absorb the sheer cliff edge of this equity curve. Notice the purple line representing equity completely falling off a cliff, followed almost instantly by the blue balance line crashing down right to meet it. This perfectly visualizes how rapidly an account is liquidated when a critical margin threshold is breached. It's not a slow, painful bleed. It is an absolute, terrifying freefall.
Let's rewind a bit and look at the lifetime journey, the months of progression that led up to this.
The context here is just absolutely crucial. See, this wasn't some flawed system that failed on day one. This started as a very humble $25 cent account challenge, and through methodical algorithmic trading, it actually grew above 200% at its peak performance. Over the course of months, it successfully navigated multiple really complex recovery phases, handling volatility that would honestly shake out most human traders. Yet, despite all of those prior months of absolute success, the total final growth sits at negative 99.63%.
Looking at the lifetime balance chart, you can clearly see how the strategy methodically pushed the equity up. It went step by step, recovering from dips, pushing all the way above 7,000 cents over several months. You see the plateaus, the steady climbs, the system operating exactly as it was programmed to do. And then, the right side of the chart, the final cliff. Literally all of that historical progression wiped out in a single instant.
Now notice how the historical drawdown spikes, which are represented by the red line, overlay against the growth throughout the year. Those historical spikes, that's where the recovery logic successfully kicked in and saved the account. Every single time the system entered a drawdown, it recovered, creating new equity highs. But psychologically, that creates a really dangerous false sense of security. It basically trains you to believe that the system will always recover, right up until the final, fatal drop, where the red line spikes violently as the green growth line just plunges to the floor.
So, what caused this? Let's talk about the macro catalyst, which was, in a word, a relentless trend.
The primary pressure test here came from the US dollar against the Japanese yen. The USDJPY remained historically elevated near the 160 region during this final week. We had persistent dollar strength, incredibly strong interest rate expectations, and relentless treasury yield support. All of that combined to create insanely challenging conditions for any system relying on short-biased recovery positions. Basically, the system was fighting an absolute macro juggernaut.
Now, of course, there was ongoing pressure on the Japanese yen, and the whole market was watching closely for potential intervention from the Bank of Japan. But here's the real kicker. Those intervention concerns completely failed to produce the sustained reversal needed for this specific system to execute its recovery cycle. The market just kept grinding higher and higher, actively denying the algorithm the pullback it desperately needed to close its short positions in profit.
Let's break down the mechanical reality of this. Here is the anatomy of the crash.
Looking at the actual trade history, we can pinpoint the exact moment of failure.
You're looking at a massive cascade of large, short bias sell positions, 0.96, 1.92, 3.84 lots, all clustered near that dangerous 160 and 161 level. As the trend pushed higher, these increasingly large recovery positions were forcefully closed. You can see those heavy red numbers on the right, minus 1,526, minus 1,676. These realized losses compounded instantly, resulting in the massive 7,101 cent deficit. This right here is exactly what it looks like when a recovery cycle structurally breaks down.
Putting the drawdown versus the deposit load side by side really visually demonstrates the system redlining. On the left, you've got the drawdown curve spiking violently, and on the right, the black line, representing the deposit load, explodes upward at the exact same time. The algorithm was desperately using up every bit of available margin to open those larger positions we just looked at, trying everything to fight the trend. The account simply ran out of breathing room.
We have to state this really clearly. The persistent USDJPY strength simply overwhelmed the recovery positions. We aren't blaming the market here. The algorithm did exactly what it was coded to do, but it was fighting a market environment that required way more margin than the 7,000 cents available. It was forced into liquidation. It's just a pure, cold mathematical certainty when a boundless trend meets a bounded account.
So what do we take away from this? Let's get into the vital lessons in risk management.
The absolute crucial takeaway is this: every trading system has limitations, and risk management ultimately determines survival. No strategy is invincible. I honestly don't care how beautiful the backtest is or how many months of 200% gains you manage to string together. Eventually, the market will present a condition specifically designed to break your algorithm. Acknowledging that risk upfront, that is literally the only way to survive long-term.
I really want to thank all of you who followed this 25-week journey. We share this because documenting this total failure is just as essential as showing the previous wins. True transparency means looking at those 8.66 cents left in the account and analyzing exactly why it happened. It maintains credibility, and more importantly, it gives you, the focused learner, the real unvarnished picture of systemic risk in the markets.
I'm going to leave you with the motto of this series: real accounts, real risk, real progression. Look at those words and ask yourself, when your trading system inevitably meets its own mathematical limit, what will your risk management actually look like? Will you survive to trade another day? Think about that for a while. Thanks for joining me for this explainer, and I'll catch you next time.